Hi, I'm Tim Kelley, Portfolio Manager for the Montgomery Fund, and welcome to this week's Video Insight. Today I want to talk about some of the dynamics we're seeing in the Australian equity market and what it might mean for your investment portfolio. As most of you will know, the last few years have been a good time to be invested in equities. The interest rate available on cash has been low and the returns from equities have been good. So investors have been well rewarded for the additional risk of holding equities instead of cash. More recently, however, the returns from equities have been more subdued. In the last 12 months, the ASX 300 accumulation index has added around 12%, and that's not a bad result, but it's down on the 20% return we saw in the previous 12 months. The headline result is one thing, but it's often more interesting to look behind that and see which individual components of the index are doing well and which are doing less well. The index tends to be dominated by a handful of big banks and miners, and so when you look at the index, you're really looking at the performance of that small group of companies. We think there are some interesting things going on behind the index numbers, and one of those is the performance of some of the best-loved growth companies on the ASX. In recent times, companies that have exciting growth stories have attracted a lot of investor support. The best internet companies, including REA Group, Seek and Car Sales, and other growth businesses like Domino's Pizza and TPG Telecom and others, have recently seen very strong share price performance and are now trading on some very favourable valuations. That's not a problem in itself. Good companies deserve a good rating, and some of these are businesses that we're happy to own. But a high valuation brings with it a level of risk. If the company disappoints, the earnings decline, and at the same time the multiple that the market is willing to pay for those earnings also declines. That can mean a very sharp drop in share prices, and so at a time like this it's important to be confident in the underlying business of high growth companies. If you have some investments like this in your portfolio, here are a few questions you should consider. Firstly, what is the competitive advantage of the business? Can you clearly articulate what it is that will protect the business from the actions of competitors and new entrants and allow them to earn a good profit margin even in difficult conditions? Secondly, how robust is the demand for the products and services they offer? Can you be confident that the market will grow over time, or is there a risk that changing conditions could mean an unexpected decline in sales or profitability? Thirdly, how strong is the balance sheet? Does the company rely on debt to fuel its growth, or can it achieve good results without recourse to external funding? If you can give a positive answer to each of these questions, then you may well be looking at a good quality growth business that deserves a premium rating. If you can't, then now might be a good time to think about whether the downside risk may be larger than the upside reward. Remember, when share prices have been running hard, the natural response for many people is to become bolder. We think it's a good time to become more cautious. That's it for now. We'll be back with more next week, and in the meantime, remember you can follow us on Facebook and Twitter.